We all know it's everyone's favorite time of the month yet again. That's right. It's stocks to buy. Not what you were thinking. Stocks to buy. What are we going to buy for the month of February? Well, let's take a look. In a time in which the market is slightly crazy right now, I just will preface this by saying I specifically pick companies that most likely will not be impacted by the rising risk of the coronavirus. It should not impact any of these stocks in any meaningful way. So I tried to stray away from any sort of consumable type companies or restaurant stocks because those are ones that certainly are getting impacted right now, and you never know with Mr. Market if he's going to be nice to those or if he's going to be super rude to them. So let's take a look. We're going to start obviously with, as I've mentioned several times, my number one stock right now is freaking Facebook. So why Facebook? Well, obviously I've had Facebook here for quite a while for many reasons. My most recent reason for it being added, well, would be the response after earnings. Since earnings, this thing has dropped 9%. We finally got to a somewhat respectable level around 220. And then they reported earnings in which guidance was a little bit lower than people expected. And by a little bit lower, I mean, what are people freaking out about? If we look at their earnings, which I certainly will take a look, I don't necessarily see where this valuation makes any sense because let's just take a look. Company trading at a PE ratio around 31.5, okay? Seems somewhat, it's not overtly overvalued, but a forward PE ratio under 20 for a company like Facebook. Am I the only one that finds that absolutely absurd? Price to expected growth of, it's at 1. Am I the only one that finds this absolutely crazy? You look at a forward PE ratio of a company like Facebook, but then you want to look at their revenue, okay? Since 2015, when they put up, that's right, $17 billion of revenue, well, since then, they've turned that into $70 billion after this most recent quarter. $70 billion. Are you kidding me? So in 5 years, they've nearly 5 times their business. They have 5 times their business, sorry. I mean, what do you want? What do you want from that? I'm just flabbergasted. This is a company with just absolute rapid growth every quarter, growing 30% revenue per pop. And on top of that, they're still extremely profitable. Extremely profitable. Look at this operating income line, in which this was a down year for them just because of a bunch of legal expenses and other expenses like that. I mean, they had a $5 billion fine they had to pay last year. They had a bunch of increased security efforts they had to put in effect, so they had to pay a lot more. And that's why the operating income was down. But this is a company that printed $24 billion just worth of cash for themselves. That's what they did. They just got free cash for themselves. Is there any way to say it otherwise? If you're looking from just a gross profit expense, which is what you want to look at the gross profit, obviously, because that's without all these garbage expenses they had to pay for last year. Look at this. A company that went from $15 billion in profit to $58 billion in profit. So that is absurd. That's absurd if you're looking off it based off the revenue. So from $70 billion in revenue to $58 billion in profit. Yikes. That is a lot of freaking money this company's printing. So why is it that people are selling this thing? Well, there's some expected loss, okay? There's expected loss in deceleration, I should say, not loss in revenue. Some slight deceleration. And is that crazy? You expect them to keep a 30% increase in revenue consistently when they're already making $70 billion in a year? I don't know where that's even feasible. Companies reach a point when they mature more, you're going to have a little bit of deceleration in revenue because of the fact that you're already making so much money. How many times do I got to talk about the law of large numbers? It's so much harder to move the scale from a meaningful percentage point when you're already making so much money. It's super difficult to. And I personally think that they sandbag the guidance just a little bit, but this is a fantastic quarter in which they continue to grow every single aspect of their business. Revenues, profits, daily active users, monthly active users, revenue per user in every single area, every single segment of the world, every single place they divide. They grew revenue per user, they grew active users, they grew everything. But they say revenue is not going to be a 30% something growth. Okay, we're going to sell out of this and now trade at a forward PE ratio of under 20, in which the whole market is pretty well trading at a forward PE somewhere around 20 to 25. And Facebook is not your daily average stock. This is an absolute growth beast. It's a profit beast. This is a company like few others out there in just terms of what they're doing. Yet, it's not getting the respect of it, right? We have companies like Apple, which is, to be fair, has transformed a little bit more into growth, which can grow revenue 5 to 10% in a year maybe. Or you have Facebook growing 30% every year. But Apple's trading at a much higher valuation. And again, it's slightly different. Apple makes quite a bit more revenue than Facebook because they're a lot more established of a company. But again, as I mentioned, I think Apple deserves more respect too because they grow revenue pretty high as of late. Their most recent earnings was fantastic, but they've been starting to grow revenue again, and it's so hard when you're a company making $90 billion a quarter. In my perspective, I think you just need some more respect for these absolute beasts. If they continue to grow, that's really what you're looking at. Walmart grows 2% maybe annually, 1 to 2%, nothing significant, but they're not getting the respect. I just don't understand why investors we're at a point in the market in which it's all about massive growth no matter what, just the percentage. They want to see that percentage growth. They don't care about what dollar value they're getting. If you're growing all these, when weed companies were super high in the market right now, people were like, oh, they changed from selling $2 worth of product to $10. I'm getting in. I'm investing in this thing. Because that's what people wanted. The 500% return. Oh my gosh, 500% growth. People cared more about percentage gain than actually what the numbers were themselves. It's absurd. Sorry, I don't want to be crazy. On top of that, with their earnings, they released a $10 billion buyback authorization. So this also is something I need to mention too. Not many companies right now are offering buybacks. They did back in 2017 when the tax bill released, and they got a lot more profit and a lot more money to play with. They all released buybacks. There's very few companies right now that are actually doing buyback programs because they ran out of that extra capital they had, and they're kind of where they want to be. But Facebook, they're pretty smart here. They're going to buy back their stock, especially while it's weak right now. I can guarantee they're buying it back while it's weak. And it just increased the value of all the shares for all of us. Let's go. I'm just excited. I think Facebook's a steal of a pick right now. I think it's a steal. I don't think there's any doubt about it. I think this thing could easily be, as long as the market doesn't have anything stupid going on, by the end of the year, this thing should be at 250. I don't think there's any denying that. So just keep an eye out for Facebook. Next, we have iRobot. I've talked about this one quite a bit. What is it about iRobot that I'm a huge fan of? Well, first off, I think overall trading at a trailing PE ratio right around 15. I don't think it's necessarily a stock that gets too much respect. If we're going to look a year out, this thing has pretty well plummeted. From its highs, this thing is down around 60%, and this is a time in which the stock market rose 20 to 30%. And they went ahead and just flubbed it. I think there's some weakness in the stock right now. I think there's plenty of room for growth in terms of valuation. I don't think there's any denying that. Obviously, a relatively long-standing company. Nothing crazy. If you look at the 5 year basis, I just think it's crazy that in 5 years it's only moved. I mean, it's moved a good bit, 20 or 50% up. Isn't absurd, but you expect to see more than a 10% annualized growth. Um, from my perspective, at least, especially for a company like this, I think they have plenty of room to grow, and I don't necessarily know if they're going to reach their highs back in the hundreds, but I do think they could easily plateau somewhere back around by the end of the year, the 70 range. And I think a lot of this past year is really dependent on the trade war, just our issues between China and the United States. And I think this is the year in which we'll get a lot done. I think there's many reasons for it in terms of Trump and his wanting to get reelected. He's going to try to get a trade deal done and show what his value is to the country. I think that's just a genius thing to do in terms of trying to get reelected for him. And I think that's what he's going to try to do. Obviously, we just signed phase one, phase two's in the works. So we will see how that goes. And if there's any sort of real good improvement in terms of trade relations, I think iRobot's going to do super well. Regardless, I mean, it's eating away at their profits a bit. There's no doubt it is eating away at their profits. But if I want to look at the company, what do they have going for them? Obviously, iRobot with their Roomba. It's an automated vacuum, very intelligent. I mean, think of your self-driving vehicle, but it's a self-driving vacuum. So guess what? You don't have to vacuum. It saves you time. This thing can vacuum while you're at work. It can vacuum however it likes to, okay? While you're home, it could do some tricks for you if you wanted to. This thing will take care of your house so you don't have to. It is just a very valuable tool to have. It does take a little bit for the AI actually to understand your room. Obviously, it certainly depends because it's not like it's going to know what your house is the second it gets there. So it takes a couple test runs, and then it learns your room, so that way it knows the route to go. And then from there, you can set times for it at this time of the day, at this day of the week. You're going to want this thing to go off, and it'll do it for you. It is just a lovely, lovely thing. So on top of that, these things can handle hardwood. So it can actually mop hardwood too. If you think about it, so they have a mop. So not only can you vacuum over like a hardwood or a linoleum or tile type environment, they do create a mop known as the Brava instead of the Roomba. You know what I'm saying? So obviously the Roomba will be your main vacuum. The Brava can mop any surface you need it to. Fantastic stuff. I mean, that's where I think they have a lot of room to grow, would be in terms of just as we look into the future. In my perspective, you think, what are people concerned about right now? And it's about leisure. It's about not putting in effort to things. People are really focused about making life easier right now. That's what all inventions are coming out right now. I mean, there's going to be a time where you think of the movie WALL-E, that's where we're trying to get, okay? Maybe not necessarily the obesity, but we're trying to get to the point where we can have machines do all the work for us. That's just really what people want. So this Brava robot mop, it's a good sector of their business. I think they could grow quite a bit, as well as the Terra. That's right, Terra, because it's, it means earth. Get it? The robot lawnmower. So, what a shocker too. I mean, what do you want? Mowing your lawn for you? Heck yes. A lot of people don't want to spend that time. Really, I mean, most people will only take a good 15 to 20 minutes to mow their lawn. But if you don't feel like spending that 15 to 20 minutes, maybe you work a lot. You've been working 60, 70 hours a week. You don't feel like mowing your lawn. Here you go. Let's look at this. You have a robot to mow your lawn for you. You don't have to pay a lawn care service unless you really want some like fine trimming, stuff like that. But it's a very interesting little machine. Just a side note too. If you think about what in the world, when robots take over and if they want to kill you, this Terra robot mower absolutely will try to chop your head off at some point. But before the AI takes over, this is a wonderful product, and people are going to love it. I am just kidding, by the way. Just kidding. But again, they have so much going on for their business. If you look at the numbers for this company, it is a company in which revenue is growing from a 500 million standpoint in 2014 to a trailing 12 month of 100 or 1 billion, and or nearly 200 million. So, 1,200,000,000. I don't know why I couldn't say that properly. It was very weird for me. But they are a company growing revenue, no doubt about it. Still at a pretty steady point. Profit is doing just fine as well. Profit's growing along with it, so there's no real concern. Obviously, just you'll see definitely an increase in cost of revenues significantly just because of the trade war. But they are reporting earnings coming up here. I think tomorrow. Is it tomorrow? Shoot, I think it is tomorrow. And with that, I think there's going to be a huge quarter. And why? Well, because it was reported that one of the top 5 items might have been an iRobot product, Roomba. So there's a potential over the holiday shopping season that there's solid demand for iRobot products. The firm, obviously this is just a report from Piper Jaffray, thinks that it will remain where it's at right now until we get a trade deal potentially. But I think demand in this quarter coming up here will be a huge impact on the stock. I think if they post a absolute banger of a quarter, I think their EPS is going to be the concern for me, obviously because you think about rising cost of materials due to the trade war. I think if you think about demand, I think that's what people are going to be concerned with the stock. If they increase revenues a good bit and the demand looks high for these these products, which again, this is a key season for them. Over the Christmas season, this is a key season for them. You know I'm saying Christmas. Let's go, baby. So if they post a good quarter, I think the stock could go up pretty big, just because how much it's been hammered. I'm finally above my cost basis on this stock too, so I really hope it keeps going up. What can I say? That's it for iRobot. I think it's a good buy. Next we have an interesting one. You know I have to invite my dividend companies into the market, obviously because Facebook doesn't pay a dividend, but it will in the future. So that's the thing. Facebook's going to pay a dividend in the future, so that's another reason why you buy it here. But I'm just talking about what you're buying for the month, Obviously, these are my choices for long-term ones too. So what is it that New Residential Investment Corp has for it? Well, obviously, you look down there in a smacking dividend yield. It's going to smack you in the face of 12%. You might think, is this a dividend trap? In my perspective, I don't think it is. So I think there's certain companies where the higher dividend can certainly be a dividend trap just to get you invested. But with a company like New Residential, I'm not super concerned with it. From my perspective, I do think it means you're not going to get the share appreciation that you expected. And if you're looking from a 5-year basis, it's a very up and down stock, but it has actually grown 25 or nearly 26% in 5 years in terms of stock price. But I don't think you're really looking for stock appreciation for a stock like this. In my perspective, this is a company I hold because it was off of its highs, which is why I picked it up. So highs around 18.5. I picked it up right here in the 15 range. So I love it. Love this stock. Actually, it's a recent purchase. I think I picked it up somewhere closer to the 16 range, actually. So I think my cost basis is right under 16 if I'm correct. I look to be adding more, though, just because of what they offer. They offer quite a bit in terms of just value because, well, first we look at what they have. Market cap, approximately $6.5 billion. Good for them. These are some quick facts about it. 147% return to shareholders since inception, which was in 2013, I believe. And a lot of that's going to be based off dividend. But if you think of that over a 7-year period, to bring 150% to shareholders is good. Very good. And it's not a dividend trap because the company wouldn't last that long if it was in a dividend trap status. Just saying. Dividend yield around 12%. Over $3 billion in dividends to shareholders since inception. Love it. $41 billion in total assets that they own. So they have the money. They do have the money to pay out. And a book value growth since inception of 63%. So not only are they just growing their dividend, they're growing everything. So NRZ's portfolio includes MSRs. So these are going to be stuff like real estate security loans, and mortgages. So call rights, residential security loans, consumer loans, complementary operating businesses, and ancillary services. So very big and diversified portfolio for them. We've achieved a scale across our differentiated and hard to replicate portfolio of value creating strategies. We are disciplined and opportunistic when it aligns with our long-term strategy. Our size, liquidity, and positioning allow us to be nimble when opportunities arise. Arise from the darkness. That was Bane. A proven track record throughout our history. We have created substantial long-term value and proven the strength of our strategy through execution and performance. I would say so historically. I think they have. So we focus on capturing full value of our mortgage assets. Okay, that makes sense. So well positioned to capture incremental long-term value of our full mortgage asset through our operating companies and partnerships and the shareholder focus. Our ultimate goal continues to be protecting book value and generating stable earnings and risk-adjusted returns for our shareholders, which, again, if share value stays consistent, which is their goal, and they're paying you at 12% per year in dividends, that's fantastic. That's fantastic stuff. What can you say? That's very fun stuff. If you look at the latest news tab, obviously fun stuff because they just release some good information, but nothing fun. Nothing super fun for them. Overall, I like it. The company really, you don't look at PE ratios for companies like this, but you know what? I did. What can I say? Trading at a market cap of $7 billion, but the enterprise value of the company is actually $37 billion. So it is something to perspective. Put into perspective there. Forward PE ratio of 8. You don't really look at PE ratios when it comes to that. Price to book of 1. That's a very, very fantastic price to book. This is showing that this stock is at the value that technically it should deserve. And that's where I don't see it being a dividend trap. That's frankly how I look at it. If you look at it from a balance sheet perspective, $940 million of cash versus a total debt of $30 billion, you might be concerned. $1 billion versus $1 billion or $30 billion in debt. Obviously, there is some concern there, but I do believe that the company is perfectly fine going forward, for sure, because it is a company that does, in fact, they make a profit. At least that is one thing to say. So they can eat away at that debt for sure. Payout ratio leaves something to be desired, and I don't think there's any doubt about that. From my perspective, I think it's an okay hold, at least for the short to mid term. I'd say a year to 2 years maybe. I think would be a fair time that I plan on holding this stock. I don't want to flood I'm not putting a large percentage of my portfolio in this, I should say. So this is currently, I believe, sitting around 2% of my portfolio, and I don't really want it to get that much higher. I don't want it to go over 5%, for the reason, as we mentioned, it's risk aversion. I try to avoid companies that are paying such a high dividend that you might be concerned because they could cut it and then the share price will go down. Otherwise, we look at revenues here too. And I did want to point this out. The company is growing revenue, actually. So it's a company growing, and from a trailing 12-month perspective, they're still growing. So it's good to see that. They've turned from a couple years of loss to growth in terms of sale of loans. Nothing absurd. From a net income perspective, they are growing net income, which I like to see, because obviously how are you going to pay your dividend out if you're not growing your net income? So let's hope they can continue to stay positive on that, and if they do, they'll be paying a dividend for sure. It's just the question is, how much are they going to be paying out? Because this is showing me a payout ratio right around 100%. Could be concerned, but I am not super concerned with that, because a lot of these, with these real estate investment trust type companies, they have to, for tax incentives, they have to pay over 90% of their revenue in terms of the company's profit. They have to pay out 90% of that just for some tax breaks. So they pay right now 50% or 50 cents per quarter, quarterly. It is a quarterly dividend. um, which is interesting from a growth perspective. Nothing crazy because they're not really growing. They really stayed consistent. They've grown obviously since 2015, where they did 38 cents. They did grow a little bit, but they've consistently been doing 50 cents since 2017. That is my perspective there. On top of that, we do see they did actually get a buy rating from Argus Research, which is interesting. So some investors do see share appreciation in the stock, which is interesting. I don't really care about share appreciation. I care about staying consistent and upping my dividend percentage just a little bit. If I can increase my dividend yield on my portfolio a little bit, I'll take it. I'm right around 3.5%, and I'm okay with increasing that. This gives me more money that I don't really plan to reinvest into the company. I plan to reinvest it elsewhere, but I am a fan of it. I just started talking with my hands for some reason. I don't know why I'm talking with my hands, but these are your stocks to buy for February. I really hope you enjoyed.